So a first-time buyer mortgage is nothing special in some ways. It's just that some lenders have exclusive products available to first-time buyers that aren't available to people that have owned a property in the past. More often than not, these are more competitive than a traditional mortgage, but actually with some lenders it's the other way around, that the home movers get a preferential rate of interest. So part of our job is to match the customer to the most suitable mortgage, the cheapest mortgage that's around, and we have access to those exclusive first-time buyer mortgages that might not be available to everybody else. So typically a first-time buyer won't have as much deposit as someone who's moving up the property ladder, but that's okay. Traditionally, a 5% deposit is the minimum that a first-time buyer will need to find. However, quite often we get situations where family members are gifting towards the deposit, and if we can get more than 5%, so for example 10%, that first-time buyer will qualify for a lower rate of interest. If there are some previous credit problems, it could be that even 10% isn't enough. Some of the specialist lenders require a 15% deposit for a first-time buyer to be able to proceed. So as a first-time buyer, how much you can borrow depends on a few factors. So obviously how much you're earning comes into that. So if you're an employee, that's your basic salary. And if you get additional income as well, such as bonus and overtime, that can be taken into account. For self-employed, it can be a little bit more complicated. For a sole trader, it's based on their net profit. For a company director, it tends to be their salary plus their dividends. So that's all the income that can be captured for part of the mortgage application, the affordability assessment. But then it's your outgoings as well. So if you have a family and you're paying childcare, that could be taken into account. Car finance, credit cards, any credit commitments that you've got could reduce the total amount that you can borrow. Now, there are certain lenders that give boosters for first-time buyers, so that would help people onto the property ladder. But there's two aspects really to an affordability assessment: how much the bank will let you have, but the most important thing is working within your own budget to make sure you've got an affordable mortgage payment going forward. So I find that for younger first-time buyers, it can be difficult and it takes time to build up their credit score. It's something like a footprint that improves and increases over time, because as you take out loans and credit cards and store cards over a longer period, you're proving yourself all the time as a good payer, and when you're younger, it's difficult to build up that history quicker. In terms of where your score needs to be, well, it's not quite black and white. I've seen customers with a 900 plus score on Experian actually get declined for mortgages, and those with lower scores pass, because it's not just the credit referencing credit score that comes into play. The lenders have their own internal scores as well. So what you can be doing to maximise your chances is make sure that you're on the voters roll. You probably do need one or two active pieces of credit. If you've got a credit card, if you use it and pay it off in full each month, that's something else you can be doing to improve your score. So I'm a big fan of getting your agreement in principle done right at the start of the journey. The biggest reason is if you get declined for that agreement in principle, then that gives you time to be doing something to improve your credit score, to give you a better chance in a few months' time. So there might be some old credit cards that you need closing down that you're not using. That can increase your score. You might not be on the voters roll, and that can take a little bit of time to get resolved as well. Now, that agreement principle lasts for 90 days, but don't think of this as like a sand timer ticking down and that you've got to buy property within that 3-month window, or that's it, you're out of the game. That's not how it works. If you haven't found a property in that 3-month window, just get back in touch with us. We'll get that agreement in principle renewed, 3 months start again, and you can start viewing properties again. And as soon as you've got somewhere, the next step being making the offer, another step that we can guide you through. So while some properties are sold privately, directly by the seller, most of them are via estate agents. So as a first-time buyer, you will contact that estate agent and put your offer forward. You can do that by phone or in writing, or by going to visit them in their office. Now, the estate agent is going to want to ask you to prove that you're in a good position from which to proceed, because if they're going to go to their seller to say that they've got a buyer, they'll want to know that they're being what they call qualified. So you're going to need to show them your agreement in principle, so that you've got your mortgage funds in place, proof of your savings for the deposit, and the estate agent will have some anti-money laundering checks to do as well, and potentially your ID and proof of address as well for the same reason. So conveyancing is a transfer of title from one person or to another person, but really what we're talking about here is the legal work that's required in buying property. So it's a game of two halves. So you're with me and my team applying for the mortgage. We take care of the financial aspects of your purchase, and once the mortgage is offered, we hand you over to your solicitor who does the conveyancing. So they'll be writing to local authority and perhaps other parties as well to get information about the area of the house that you're buying, drawing up contracts, checking that the seller actually owns the property, what fixtures and fittings are getting left behind, and who's responsible for the various walls and hedges adjoining to your neighbour's property. So conveyancing really is the legal aspects of buying a property. All first-time buyers really need some form of insurance when they're taking out a mortgage. Now, if you're buying a house, a freehold property, then you'll need builders insurance, and that will be a condition of the mortgage, because if the property is seriously damaged by flood or fire, then the bank needs to know how they're going to get their money back. That you can't just walk away from it. So they will mandate that you've got a builders insurance in force and maintain at all times. It used to be that some lenders made you do the insurance policy with the lender, and that's been relaxed across the board now, and you can do your builders insurance wherever you want. Now, most people add contents insurance to the buildings policy so that your stuff is insured against things like burglary. But there are other insurance options as well, which we will walk you through at the point of your mortgage application. But for example, there's life insurance, which pays the mortgage off if you or your partner were to pass away prematurely. Critical illness insurance, which pays out a lump sum if you're diagnosed with a serious illness such as heart attack or cancer or stroke. And income protection insurance, which pays your monthly amount to maintain your mortgage and bills if you're unable to work.